we'll have inflow and outflows of money. I hope you see the. Okay.
Yes, we see.
Okay. All right. Over to you, brother.
Yes. Okay, so today we are going to look at cash flows to understand what it means and what is also the difference between profit and loss. You can move to the next slide. So we are going to see what the defining cash flow management, importance of cash flow management, components of cash flows, operating cash flows, investing cash flows, and financing cash flows. Defining cash flow. Cash flow is the movement of money in and out of an organization, and is different from profit and loss, even though these two will contribute to changes in cash flow. So we shall, after with examples, we shall understand it a bit better. And then cash flow is the lifeblood of an organization and is the primary indicator of a business health. So it is the movement of money in the organization. Yes, next one. So cash flow management define it as the process of monitoring, analyzing and adjusting an organization's cash flow. The most important aspect of cash flow management is avoiding extended cash shortages, which are caused by having to create a gap between cash inflows and outflows. And an organization would not be able to stay in operation if it is not able to pass its bills as they fall due. Okay. Then I have then the cash conversion period. Cash conversion period measures the time it takes to convert your product or service into cash flow. So it comprises of three aspects. First is inventory stock conversion period. So it is what you have in stock, how long does it take to convert the stock into cash. And then also receivables, debtors, conversion period, so to know when your debtors are paying you, and also payable creditors, the deferment period. We shall have some exercises also about it. Next one. Then, so cash conversion period is the inventory stock conversion period. This is the time stocks remain in stores before delivery to customers. This will also include time in the production process, like work in progress. So the formula is the average stock times the year, 365 days, divided by annual sales. I think now what I was thinking, maybe we go through, and then with the examples that I have at the end, we can come to understand these exercises and the formulas. So we can move to the next. Then cash conversion period, so receivables, debtors, conversion period. This is the time taken to convert credit sales into cash. It is computed as follows, so it is average debtors divided by the annual credit sales times the 365 days. So this is the formula used. And then cash conversion period are the payables, creditors, deferment period. This is the time it takes the organization to settle creditors. It is computed as follows. So the average creditors times 365 divided by the annual costs of goods sold. The cash conversion period consists of the conversion of net of one, which is the inventory, plus the second, that is the debtors, less the creditors. So the trick is to minimize 1 and 2 and maximize 3. So the steps into cash flow management. So to prepare and monitor the monthly cash budget. So so I have to see, how if we are inside or if you are spending more or if you are making profits. Then to accelerate your cash inflows, so to make sure that there is more cash coming in or the income is higher than the expenses. Then short the cash and conversion period. To negotiate longer repayments period with suppliers. So, and to arrange a temporary overdraft facility with your bank. Yeah, wait for. So the benefits of a good cash flow management is it helps you avoid stressful cash crisis, helps you to reduce unwarranted investments in working capital, helps you avoid holding excessive cash which does not earn interest. So when you have too much cash, you can open a save account and then you will have interest and it is another sort of income. Then can contribute to profits by avoiding late payment charges and enables you to take advantage of suppliers' discounts. The working capital reflects the amount of cash tied up in trading assets. It is calculated as stock plus trade debtors less trade creditors. Management on working capital require computation of days debtor take to pay, days taken to pay creditors, and days stock remains unsold. Components of cash flows are the inflows, which is money from cash sales, collected from debtors, bank loans received, interest received on investments, sales of fixed assets, offerings and tithes, contributions by members, and donations and grants. Components of cash flows are the outflows, cash purchase of materials, payment to creditors, bank loans repaid, payment for operating expenses, like salaries, purchase of fixed assets, payment of interest on loans, scholarships, payment of taxes, and payment of dividends. The effective cash flow management is all about balancing the cash coming into the organization with the cash going out of it. So the challenge is that demands for cash to pay for expenses like salaries, rents, may arrive before cash owed by debtors is collected or goods services sold to customers. So the issue, as I said before, is to avoid the stress, or to make sure that you have money available so that you meet the expenses that are due almost every month or month. So advantage of good cash flow management, you can stop potential cash flow gaps and take action to reduce their impacts, is reducing dependence on banks. So the less you depend on banks, the best or the better. Plan your investment in long-term assets, identify cash surpluses that can be put on fixed deposits without risking operations, and assurance of good credit rating from banks and suppliers. For example, even this one identify cash supplies. Or for example, you can find some funds on which you allocate money so that if anything goes wrong in any level, so that you have money ready to be used in these cases. A bit up, yes. Now, statement of cash flows. The statement of cash flows is the link between the income statement and the balance sheet. It explains why the change in cash resources between two balance sheet dates. To prepare this statement, you need to compare the current balance sheet with the previous year's balance sheet. So then for it, you need these different banks, these different statements, so that you are able to understand the movement of money in your organization. So statement of cash flow, there are three types. One is operating cash flows, the investing cash flow, and financing cash flows. So statement of cash flow, operating cash flows represent the inflow and outflow of funds as a result of trading activities, example, sales of goods and services, purchase of stocks, supplies, and payment for operating expenses such as salaries, rent, electricity, taxes, advertising, etc. Investing cash flows represent the inflow and outflow of funds as a result of purchase and sale of fixed assets, investments in companies, interest, dividends, received and recovery of loans advanced to others. The financing cash flows represent the inflow and outflows of funds as a result of issuance of shares, long-term borrowings, short-term borrowings, repayment of long-term and short-term debts, and interest dividend payments. Now, net cash flow. The net cash flow from each of the above activities represent the change in cash and cash equivalent balances from one period to next, and explains why cash balances have reduced or increased depending on whether the change was positive or negative. So we shall have also some examples on this aspect. Okay. So, where is it? Okay. So let us go to some practical work. I think it is this. Yes. So now we are going to understand a bit what is the cash conversion period inventory. That, as we saw at the beginning, it is the conversion period measures the time it takes to convert your product or service into cash inflows. So imagine that you had an opening stock at the beginning of the year, amounting to 1,500 rands, and closing stock of 1,500,000 rands, and stock closing of 2 million rands. So the formula is the average stock is you add the closing balance plus the opening, and you divide it by 2. So if you add 1.5 to 2 million, it comes to 3,500,000. Divided by 2, you get an average of 1,750,000 as a closing stock. And imagine that you had a total sales of 12 million. So to know the average it takes, so it is that average stock times 365 days divided by the annual sales. So it is 1,750,000 times 365 divided by the 12 million. So it gives, it is according to the result in your calculators. Some give 51, others give 53 because they have more numbers after the comma. So the average of stock conversion of what you have in this case in your stock, it takes either 51 or 53 days for this stock to be converted into cash. Then the average storage period is calculated using the following. So the formula is average store period is what it says in here, 360 days divided by inventory turnover or the annual sales rate. The inventory turnover rate indicates the average period over which goods are replaced in the warehouse. So the average storage period is calculated using the following formula. So average store period equal to 360 days divided by the inventory turnover or rate. So the inventory turnover rate indicates the average period over which goods are replaced in the warehouse. So the important, so the formula. So the first is to be clear that the closing balance or the closing balance at the beginning balance of the new year, then divided by 2, so you get the total average. Then when you have this one, you multiply this amount, the average, by the multiply by the year, 365 days, and divide by annual sales. So then you will get the days. So you take it takes to convert into cash. Then from the previous formula, sorry, this one. So for them now the time to convert, no, this is not this one, sorry. This one, I went to the wrong one. So the previous formula is, yeah, so to convert the debtors into cash. Why does it come different? Okay, so the previous formula is meant to be understood before you get a customer. So in case of debtors conversion period, so the time taken to convert credit sales into cash, this is the formula. So it is average debtors times 365 days divided by annual credit sales. So suppose you have an opening debtors of 500,000 and a closing debtor of 2 million runs, and then an annual sales of 15 million. So first you add the opening debtors, sorry, like the formula before, to the closed debtors and divide by 2. So 500 times 500,000 plus 2 million is 2,500,000 divided by 2, it comes to 1,250,000. Then you apply the formula, so the average debtors times 365 days divided by the annual credit sales. So it is 1,250,000 times 365 divided by 15 million, sorry. So it comes to 30 days. So it takes 30 days to convert credit sales into cash in relation to debtors. Now, when we come to creditors conversion period, so this is the time it takes the organization to settle creditors. So it is more or less the same way. So the average creditors times 365 days, annual cost of goods sold, cost price. So for example, imagine that you had a vehicle and you sold it for 2 million and you had an income, I mean, you bought it, yeah, so it cost 2 million and then sales income of 2,500,000. So the profit was 500,000. So you spent 2 million, but you paid 2,500,000 or opposite. So the imagine that you had an opening creditors of 600 million, 600,000, sorry, and the closing creditors of 400,000 and the cost price of 10 million. So first you add the 600,000 to the 400,000 divided by 2. So you get the 500,000 that is up there. So the average creditors is times 365 divided by the annual cost of goods sold, cost price. So 500,000 times 365 days divided by 10 million, it comes to 18 days for the organization to settle the creditors. Now the cash conversion period. So the formula for calculating the cash conversion period cycle is cash conversion cycle is equal to the DO plus DSO minus DPO, which means the DO stands for days in inventory outstanding, DO stands for days sales outstanding, and DPO stands for days payable outstanding. So then it is equal to the cash conversion period is so 1 plus 2 minus 3, as you saw in the cash conversion period. So then the example is the first one, the inventory took 53 days, then plus 30 days for the debtors, minus 18 days for the creditors. So it takes for you 65 days to convert all the three steps into cash. So the trick, as it says, is to minimize 1 and 2 and maximize 3. So this one's the first and the second should take less days, and so that it helps that you get cash to pay your creditors. I hope it is understood. Now let's go. So let's also understand that now the other. So this is that was the way to understand the inventory, then debtors, and the credit conversion that appears into cash. Now we are going to also to have some examples of cash flow. What are cash flows? What it means? So examples of cash flows include money spent on fixed assets like salaries, payment made to suppliers, loans taken, and interest paid on them, wages, transport costs, and insurance dividends that require to be paid. So the difference between cash flow and outflows, or in cash inflows and cash outflows, is fairly straightforward. Cash inflows is the cash you are bringing into your business, while cash outflows is the money that is being distributed by your business. So what does cash flow mean? Cash flow refers to the net balance of cash moving in and out of business at a specific point in time. So it can be weekly, monthly, quarterly. It depends how we look into the different statements, moving of money. So cash is constantly moving in and out of business. For example, when a retailer purchases inventory, money flows out of the business towards its supplier. Now, cash flow does not include what is there in the bank and the credit from suppliers. Neither does it include the money other entities or your business. Now, is cash flow a profit? No. There are stark differences between the two metrics. Cash flow is the money that flows in and out of your business throughout a given period, while profit is whatever remains from your revenue after costs are deducted. What is cash inflow? So when we talk about cash inflow, we are talking about money coming into a business account. It comes from all sorts of sources, including sales, loan investments, cash flow. Yeah. Then cash flow is considered a positive event, as it means there's more cash available for the recipient. It is important. It is an important aspect of cash flow management, as it helps to ensure that the business or individual has enough cash to cover expenses and investments. So what is cash flow? Cash flow refers to anything related to the payment of cash from a business or an individual, including expenses and other financial obligations that require the transfer of money. Cash outflows can be anything from employee salaries to loan repayments. It is considered equally important as a cash inflow, as businesses needed to ensure that there is enough cash available to cover expenses and prevent cash shortages. So we have some examples of what is a cash inflow and outflows. So cash flows is the net cash, then cash amounting coming into your business that you have available for a period of time, and cash outflows is the net cash amount that is going out of your business because you are paying someone else or another entity. So here are some examples of cash flows: is the cash sales, receipts from trade, customers, sale of assets, investment or share of capital, personal funds invested, receipt of bank loan, government grants, receipt from factoring. And cash flow examples: payment of wages and salaries, payment of suppliers, raw material stocks, buying equipment, interest on bank loans or overdraft, payment of dividends, repayment of loans, payment of leasing or hire, purchase rental, income tax, VAT, and corporation taxes. The net cash flow is calculated by subtracting all expenses from revenue. For example, if a company has 100,000 rands in revenue and 50,000 in expenses, its net cash flow is 50,000 rands. So to calculate the net cash flow, simply subtract the total cash flow by the total cash inflow. So the revenue 100,000 less expenses 50,000. So the net cash flow is 50,000 rands. The formula for operating cash flow is operating cash flow equals to operating income plus non-cash expenses, less taxes, plus changing in working capital. So imagine that in a restaurant, is cash flow, therefore equals to 20,000 plus of operating income, plus 1,500 of non-cash expenses, less 4,000 of taxes, and here in this case, less 6,000 of changing in working capital. So it giving it a positive operating cash of flow of, it should be 11,500 runs. So it is like this: 20,000 operating income, one plus 1,500 of non-cash expenses, less 4,000 on taxes, and less 6,000 on changing in working capital. So you come to a cash flow of 11,500 runs as operating cash flow. Now, of course, this exercise, then I will send to the sister to share with you maybe the full paper so that also you can be able to understand, because it is not maybe so easy to understand in this way, but at least we have got an idea. Now, how do you calculate net cash flow? So subtract total cash outflow by total cash inflow. And the net income is the profit a company has earned for a period. Can be you can do it weekly or monthly, quarterly, so it depends on the average time. But it's also good at least beginning by a weekly while cash flow from operating activities measures in part the cash going in and out during company's day-to-day operations. But it also good this one. So net income is the steering in calculating cash flow from operating activities. Then what is net cash? Net cash is a figure that is reported on a company's financial statement. It is calculated by subtracting a company's total liabilities from its total cash. The net cash figure is commonly used when evaluating a company's cash flow. Then net cash flow from investing activities is the amount of cash generated and used by a business from its investing activities. To calculate net cash flow from investing activities, the business must subtract cash used in investing activities from cash generated in investing activities. So now we have here an example of a net cash flow. So it runs in thousands. For example, you had a net income of 100,000, and you had a depreciation and amortization of 20,000. So it comes to under 120, and you had an expense or a net work of 10,000. So the cash flow from operations is 110. Then this capital expenditure of 80,000. So cash flow from investing 80,000. Then 110 minus 80,000 comes to 30,000. Then you have issuance of long-term debt of 40,000, and the repayment of long-term debt of 20,000, and issuance of common dividends of 10,000. So the cash flow from financing is 10,000. So 40 as income, then 30,000 as expense comes to 10,000 profit. So then under than 10 minus 80 is 30, plus 10, it comes to 40,000. So the net cash flow is 40,000 runs. Then also how the cash flow statement follows in this way. Cash flows is equal to 930. This should be 1,000 or even runs, just simple runs. Imagine that you had sales of 70,000, 1,000 runs, and you had an expense of 70, so you remain with 930 runs. And if you have a cash flow of 900, which means that you purchases use of 500 runs, then you have a debt of 20 runs, and cashing operating charges of 250, and interest of taxes 60. But you have the other creditors minus 40 runs. So then the investments of 100 runs and other investments of 50. So the cash value, so then so when you subtract 20 to 500, or better, you add 500 to 250 to 60 and 150, so it gives one amount, less 20 and 40, it comes to 900 runs. So then you have the cash inflow of 930 and the cash outflows of 900. So your cash variation is 30 runs. So it is positive of 30 runs because the income was more than the expenses, or the money coming in was more than went out. So in this case, for example, when you are making money, so this money is good because it keeps the business running, as we saw at the beginning. Money, the cash is the lifeblood of on an organization or entity. So why does business cash flow matter? It ensures that the survival of the business. Cash flow is the lifeblood of any business. It is essential to keep business running by paying employees, suppliers, and other expenses. Without adequate cash flow, so this comparison of money coming in and going out, a business can run into financial trouble and potentially go bankrupt. It helps with financial planning. So cash flow is an important factor in financial planning. By forecasting cash inflows and outflows, business can plan for the future and make informed decisions about investments and expenses. So, for example, in this aspect, also you can compare even to the budget. So that you make a budget for a month. So then you also so the comparison of the cash inflows and outflows, you can see if you are inside, or if you are in, maybe this month maybe we had less income, but you have more expenses. So then we are going to see if the money even that came from the last month is going to be enough to cover your expenses, or if you have to borrow money from somewhere else. Yeah. So it makes a business more attractive also to investors. It helps with tax planning. So it's a bit like our school. So if we have good results at the end of the month or the end of the year, so even also if teachers are committed, so we attract more students. If there's poor performance, so people run away, and so there is no lifeblood in this institution, this school. Then, for example, now what I'm going to share with you, like this is a summary, but for example, like what happens in each month. We say this is a 6-month cash flow. For example, maybe, for example, in our congregation, we have a 3 months, but this one is a 6. So, for example, you had the opening, so you began in January 2021 with 0 runs in your account, but you have sales of 5,000, so you sold something, and then on business loans someone paid you 20,000, so it comes to a total income of 25,000, or so total inflows of 25. Then on the cash flow, so you paid rent to 2,000. on salary is 10,000, on marketing, so announcing, making your center known, 2,000. You had no loan repayment, but you spent 2,500 on equipment and other outflow 5,000. So it comes to a total outflow of 21,500 rands. So now when you subtract 25,000 total inflows from the 21,500 outflows, you have a net cash flow of 3,500. Okay, as we saw before in our text, because it doesn't mean that this is a profit, but it shows you how the money went in and out, so that you manage to keep the business running, because still you make somehow a profit of 3,500,000. Now, when you begin the next month in February, so this 3,500 rands is reported as opening balance for this month. Then you have sales of 10,000. So the total inflow is 10,000 rands, because you sold. The total inflow is 10,000. And then you add the rent, the same 2,000 rands, salaries 10,000, marketing 2,000. Now you add a loan repayment of 500, and you add the other of 5,000. So it comes to total outflows of 19,050 rands. So it shows that you have a deficit of 9,050 rands. So it means that even though you had 3,500 at opening balance, but what you had as income, which comes to 13,000, it doesn't cover for to meet the expense. So we had, that's why between brackets means it is negative. So we had a negative balance of 9,050 rands. So then you the closing balance is 5,500 rands. So when you subtract from the 3,500 there. So now again, so this 5,500 is going to be the opening balance of the month of March. And so it goes on like this all the months until you arrive in June. It's cutting a bit. So in June, let me see. So you had you began June with a negative balance of 550 rands, but you had an income of sales of 30,000, total inflow of 30,000. But so you had a rent of 2,000, salaries 10,000 as expense, 2,000 for marketing, 500 again for loan repayment, and 4,500 outflow, and total outflows of 19,000. So but you had a net cash flow of 27,000. So now this 27,000 is the amount that you are going to use as opening balance for the month of July, which is not here for now. So then in June, so that you had so at the end of June, you had a negative balance of 550, and then sales you spent 95,050 rands. So if you sum all this, comes to 95, 20,000 of business loan, 115,015 rands on total inflow. So this is the income of 115,000. Then as cash flows, you have 12,000 in rent, 60,000 in salaries, 12,000 in marketing, so 2,000. On loan repayment, you have expense of 2,500 rands, and equipment 5,000 rands, other outflows of 28,500. So the total outflows is under 19,550, while the inflows is 115. So the total net cash at the end of June is 26,450 rands, so which agrees with the closing balance of 26,450. So so this shows a bit what is money. So we have, as we saw one of the explanations. So there is so the opening balance, and then plus the closing balance. So this closing moves to the following month, and so that at the end of the period, so there's a difference between what was the income, what was the inflows, outflows, plus the opening balance, and you see what is your closing balance at the end of the month or of the quarter or 6 months. Just also for example, now I think, for example, you are familiar, for example, with the personal reporting to your community, for example, to your superior or accountant. For example, this is, for example, like mine here internally. For example, I have a sheet of paper where I am supposed to submit to the bursar what, for example, what was my income. For example, for example, this month I didn't receive any money, but I brought a balance forward of 1,610. So it appears a total income of 1,610. And then I had a few expenses. So then, so it shows where the money was spent, and it shows you. So, and I spent 809 runs. So that is the expense, and I have a balance put forward of 801 runs. So then, when I give the report to the bursar, so so I give this one. So then this amount 801 will be shown as a balance of the previous month. So then you now you continue with your activities. Now, if you need money from the person, then you need to register in this line what you receive from the person, or if you had any ministry or donation received or mass intentions or any other entries, you register in this allocated space. So then it will give you a total income of what you receive, and then also you show again what were your expenses, and again after this is the net, so deducting the income less the expenses, so you will get the balance for the next month. Just one more thing. For example, so we have we call it a template. So we have each community. So they have their what's the financial situation. So then every quarterly report they are supposed to report, to register what was their income, and then the total incomes, then the expenditures, what were their expenditures, and then for example in this one year they asked what was whatever, so the balance brought forward from December, or now for example like now March should appear here, and and then here the gain or loss depends on the difference between the total income and total expenses. So then I put, if it's gain, just put it positive in this line here. If it is negative, has to put minus the difference between income and expense. Then here they have to say how much money they have in the accounts, in the bank accounts. And then if the community has some cash right here, then if you have projects also, at the end, so all these blank spaces are filled according to what they have. And at the end, the amount of total balances should match. So if this one is equal to this one, it means that all the accounts are correct. If they are, it means a mistake took place along the way. Okay, this is a bit my sharing. So, okay, now, because it is always a good that as I do, because I didn't get everything, but for example, it's also good that you have time to go even to the computer, to Google on these topics, and then you will get more information. Now, as a colleague of mine from is from Nigeria, he sent me a book where these topics are somehow, I think, even from which our kids. So I'm going to share this link or this book with Sister Tao that she may can afterwards send them to your emails, and so then you can go through and have more enlightenment on them on the topics. Thank you.
Yes, thank you very much.
Thank you very much.
Mm. Yeah, if you share those file with and then the sample, I think would be helpful
Yes,
for the members.
yes.
Yeah.
Yeah.
Okay. And the books as well. Mm.
The book as well. Yes.
Okay.
Good.
So the next one will be on the 11th of July.
11th July, yes.
Yeah. Okay. Okay. So we go back to Tuesday. Only today.
Yes. Back to Tuesday, yeah, until September.
Okay.
Unless there's anything in between.
Okay. So yeah, I think it's quite clear with all the samples and all the explanation, I think. Yeah. Yeah. So thank you very much, brother, for your
welcome.
information and everything. Thanks so much. And yes, we will see you again on the 11th of July and wish you the rest of the day and also the good week ahead of you. Thank you. Thanks
Thank
so
you.
much.
Thank you.
You take care. Okay. Thank you. Bye-bye.
Thank you. Bye-bye.